Hello, welcome back to another episode of Finance Agents Live. This is episode 60. I'm going to real quick run through what's going to happen on the show today, then afterwards we're going to go into more detail. But we have a message for you. We are looking to buy defaulted mortgage notes directly from institutional and private lenders. If you know people who are the people who do this, the asset managers or principals at private lenders, the ones that actually manage the notes, contact us. Make an introduction. We will work directly with the lender, and then we'll pay you each time a deal funds. You're not moving the slides forward at all, dear. Anyway, technical difficulties. All right. So if you want to do this, go to FINANCEAGENTS.net. Please only do this if you actually know somebody. We're looking for people who have pre-existing contacts with asset managers and private lenders. Go to FINANCEAGENTS.net. We have a special page set up that just talks about what we want to do. Go there, fill in the form, and I personally will be contacting you. This is my own project that I'm going to be managing myself, and we're looking to buy some notes. We initially have about 10 million earmarked for our default fund. We're going to start there, kind of see how it goes, run it for a little bit, but we have the possibility to ramp up for a lot more. Okay, so with that said, welcome to the show. We're going to go ahead and get started now. We're going to go into a little more detail on what we want to do and what we want to buy. If you're new to the show, subscribe, and then you can watch us all the time. Anyway, so I'm Tim MC. This is David Crantz. David Crantz is the president of Lendterra. That's our real estate lending group. He's the one who's actually going to be doing the buying. And you know me, I'm here all the time. So let's go into a little detail on what we buy. All right, so if we want to buy defaulted mortgage notes, what in general are we looking to buy?
Well, Tim, we're going to be more flexible buying defaulted notes than we are on our lending side.
Okay. So I was actually surprised when I heard about that. I thought it might be a little stricter because they're already defaulting.
But that's okay. What we won't buy is non-owner occupied and land. Other than that, everything else is wide open for us to come in and buy defaulted mortgage notes and defaulted deeds of trust from asset managers of banks, credit unions, finance companies, and private lenders.
Okay, now if you're watching this, if you have contacts or you've done this in the past, then feel free to go ask questions in the question box. Darren is going to interrupt us as soon as you ask anything, even if it's a ridiculous question. Darren's going to interrupt us and we're going to answer the question right away. But in general, there's two main categories of things we're looking for. It just can't be owner-occupied and it can't be land.
That's
right?
Correct.
Besides that, we're able to buy notes on stuff that we normally wouldn't lend on.
Such as construction.
Such as construction. We will buy a defaulted construction note. We will buy a note on a special or a single-use asset that maybe we wouldn't do the original loan on, but we will on this one. So what are the things that you're looking for? So if someone makes an introduction to us with a bank, the bank sends us 100 defaulting notes. What are you going to look for? Which ones do you want to pick? What are the target loans?
I think one of the obvious things, Tim, is you're looking for the deals that have the equity in them, would be the first thing. And the second thing you're looking for is the ability to rewrite the loan and reinstitute the loan with the borrower and get them back on track again. So those are the really two things that we're looking for, the equity and the ability for us to rewrite the loan with the customer and get them into a situation which we call reperforming.
Okay, so our goal is to take a non-performing client and work with them. Maybe we can give them a discount on the mortgage,
right,
or redo the rates so that we can get them back to a place that they're performing. Now, what if we call them up and they say, there's just no way I can pay anything?
What we would do in the case like that is we'd offer them money for what's called cash for keys or a deed in lieu of foreclosure. And what we would do is we would offer them cash and they would turn the property over to us. We would go ahead and liquidate the property at that point.
All right, so either way, they're in a better position than being in foreclosure or defaulting on a note.
Right.
And so we're able to do this as much as we want, right? What kind of things would kill a deal? So if you're looking, again, at these 100 loans, is there something you would see where you say, this one's
it really always comes down to equity and the value of the property. As you know, the minimum market value that we need for our loans as well as buying default loans is $100,000.
Okay, $100,000 would be the minimum
market
loan amount.
And market value.
And market value. So the minimum, so if a property's worth 90 grand and they only owe 10 grand on it, not necessarily interested. I know that's kind of an extreme example, but generally the loan's
an
going to be
exception.
100.
Where we have trouble, Tim, is houses that are worth $40,000 to $60,000. There seems to be a lot of properties in the marketplace out there that are the $40,000 to $60,000 range, and we're just not really interested in that type of value property. So the value of the property must be at least 100 grand for us to take a look at it.
All right, and it just can't be the owner living in it. Now, one of the things we do on our regular lending is if you come to us to get a loan, we are not lending to an individual. If you don't have an LLC already created or a corporation, we'll have you set one up. Are we going to have that same rule with defaulted notes?
No. And the reason you're not going to have that note is because you're buying an existing note from the bank, the credit union, the finance company. They've already set their rules in place with their Joe borrower, if you will, and you're buying that loan as is. So in many cases, we will not be buying it from an entity. We'll be buying it directly from the bank, and it'll be a direct loan to the borrower, not necessarily an entity.
Now, if the thing that you're most interested in is the equity,
Yes.
let's say again, we're looking at this 100 loans, trying to figure out which ones we want to buy. How do you know the equity? So these might be 5-year-old mortgages, right? You're not going to contact the borrower and ask him to pay for an appraisal to decide if you're going to buy the note. What do you judge that value on?
We'll do our own comps in-house.
Mm-hmm.
We'll do our own due diligence in-home. If it's something we like, we will. If we think we need it, we'll pay for an appraisal. Typically, we'll use the old appraisal that the bank has, and we'll have brokers go out there and look at it to make sure we're still in line with that appraisal.
Okay, I think we got a question. Darren's
Yeah, we do.
getting ready.
All right. So Sherwin asks, can we get funding to buy notes as well?
Can you get funding to buy notes? That is different.
We would be interested in maybe Jay being with you.
Maybe working together on it. Okay, all right, that's interesting. I wasn't expecting that question, but an interesting one.
But we have answers for everything.
All right, great. So let's talk a little bit about what can kill a possible deal for some more. All right, so let's say you're looking at these deals and you've got 10 of the 100 are in bankruptcy. Is that going to be an impediment to buying the note?
Not at all. Because your mentality of buying these loans is a lot different than it is when we make direct CRE loans. We know we're buying things, and this is a long-term basis where we could be, holding paper for 2 years without receiving any payments. So our fund is prepared for that. Our default fund is prepared for that type of weight. It's all about yield, not so much cash flow. So if somebody's in bankruptcy, but the rest of the deal makes sense, we're still going to look to make buy that defaulted loan from the bank.
Okay, so are you analyzing the original loan that they did to ensure that it was completely legal before you buy it? Is that something that you do?
It's two good question. The answer to your question is we do. We have our attorneys review it, but typically what will happen when you buy loans from banks, institutions like this, is you go into an agreement with what's called a loan sale agreement, and in the loan sale agreement, typically the bank will indemnify us as a new buyer in case there's anything that was done with the loan originally where it may have made an invalid loan. So we're going to be indemnified typically from the bank, so it's not a real concern what that original loan looked like.
Okay, all right. So it doesn't matter that they're in bankruptcy. Are there some states that you like better than other states?
Well, obviously the western states are the best states for us because they're deed of trust states and the foreclosure process is a lot faster. But, with our money, we can't be picky. We need to look to lend all over the country.
Okay, all right. So let's talk about some examples of notes that you've done in the past. Are there any specific examples you can come up so people can start to wrap their mind around how they, and let's go through the whole thing. Who did you, and don't say the exact name obviously, but who did you talk to? How did that process go? What was the actual loan like itself? And then what happened after you bought the note?
Okay. A couple of deals come to mind. One of the deals that we bought, it's no big deal, we'll tell you, we bought it from Wells Fargo Bank. It was a deal down in San Diego, California. It was a
condo, right?
Condo complex, apartment complex being converted to a condo complex. The guy wasn't able to make payments for a couple of months on it. We had bought it was about a $2.1 million loan that we paid, I believe, about 1.34 was, I believe, the number. I have to look it up again. So we got a substantial discount from the bank. What we did is we went back to the individual borrower, who was actually a really pretty good guy, and we were able to reperform him, and we even gave him a discount. So we bought the loan, I think, what did I tell you, 1.9 I think it was?
I think you said 1.3. You said
Oh.
2.1 and 1.3.
1.3.
Well,
Right.
this is a few years ago.
It
so
was, and we
a
went
little
back
fuzzy.
and rewrote the loan for just a couple of dollars more than what we originally bought it for, and that in turn was our profit, and we made a pretty good yield, and he ended up paying off.
All right, so by reducing the principal, his payments are lower, and then that was something that he could manage. And you kept that loan for a while, and then
It was a win-win for our investors. It was a win-win for the borrower. Unfortunately for Wells Fargo, they took a little bit of a hit, but they
Okay.
wanted it off their books, and they seem to be able to afford a hit like that.
so that's a big discount. Is that going to be the rule? We're trying to figure out how we can buy a note at 60%. That's a huge
That was a big
discount.
discount. They wanted it off their books pretty quickly.
But what are the loan to value? You know, normally our loan to values are in the 50 to 65% range. That's our normal loans. How high will you go on loan to values for the current loan with the bank? If it's 80% LTV before we get there, is that something you consider?
We would need to cut it back to where we're at 60% loan to value.
You're saying is we would look at the loans and it would come down to the negotiation of what we could get it down to with the bank, right?
That's correct.
So if you have banks with 80% LTV loans, we can still look at them, and it's going to come down to if we can negotiate enough of a discount that it still works for our criteria. But it doesn't necessarily have to be 50. It might be more than it normally is, right?
That is correct.
Okay, so the first example was a condo complex where you're able to get a substantial discount. How did you find that deal?
It was a broker who brought me the deal. He came in, said he had some really good friends that work for Wells Fargo out of the San Antonio, Texas branch. He presented the deal to me. I says, if you can get this deal done, we'll make it, and we'll make it quick. We ended up funding in like a 2-week period of time, and less than 90 days, we restructured the loan. The guy was reperforming and ended up paying off.
Okay, great. So a broker introduced you to the guy at the bank. What was it like talking to people at the bank? Do you feel like this is a real competitive space where you got a bunch of other buyers and multiple negotiations happening simultaneously? Or is it a relationship business where if you just know the right person, you can get the deals? What is that like?
Well, obviously you need to have a good relationship with your banker, because a lot of people hit them up, say, I can do this, I can do that. You have to be a proven entity to them, and we'll back you with that. I mean, we'll give you the financial statement you need to walk into the bank. We'll let them know that you're our partner, and we'll put up our financial statement so they know they're dealing with somebody that can perform for them. But once you get in there, what you're going to find is that not that much competition is there for the deals that are non-performing. You'll see it more on performing deals, believe it or not, because there's a need for the hunger to buy these deals. But on the non-performing side, there's not a whole bunch of groups going around the country buying this type of project. Or
Great.
property.
And if you're familiar with this, you know we're funding loans that other people won't do in the same way we're going to be buying notes that other people won't buy, which is a big opportunity because the banks might have had it sitting there for a
Months,
year,
yeah.
you know, and they want to get rid of this stuff. So I think Darren has another comment.
Yeah, so we do have a question. This is Jerome Johnson. Will you buy performing notes?
Yeah. I mean, we can, right?
We do.
It depends. It's maybe
Our
less in it
yield-
for us.
Less in it for everybody. Our yields are a little bit higher on performing notes, but we look at anything. I mean, listen, we're sitting on a trove of cash out here. We need to put it to work. We set up the second fund to buy defaulted loans, so we're just desperate to get our cash working on the street.
I think it's going to be a lot harder for the deal to work if it's a performing note. Most lenders are not going to want to sell a performing note and some sort of a discount, right? I mean, maybe a small discount, but not that much.
Typically what you're going to find on the performing notes from banks is you're going to find these major banks went in and bought smaller community banks. And when they bought these community banks, the banks made loans that don't necessarily fit, let's say, Bank of America's guidelines, Chase or Wells Fargo's guidelines. And they'll be performing loans, but they'll be looking to sell them up. Wells Fargo, for example, bought a community bank. And when they bought the community bank, they inherited all the loans that community bank made. Now, Wells Fargo, for example, may have a process or a procedure or a rule which says that they don't lend on auto body shops, for example.
Right.
Well, maybe this auto body shop is paying perfect, but Wells Fargo can't have it on their books because it doesn't lend to an auto body shop. Those are the performing deals we'll buy, but don't expect big discounts or big commissions on them because they're performing. Where you're going to make the most amount of your money and help your banker friend out is buying his defaulted non-performing debt. That's the money.
Okay, great. So we're talking a lot about institutional lenders. There's a lot of private lenders out there who might be even happier to get rid of a note because they have less access to a market. So let's talk about the differences between buying something from Bank of America versus buying it from Bob Lender.
Okay. I think sometimes the banks will be a lot easier to deal with. And
Really? Easier?
Oh yeah.
Okay.
And one of the reasons is quite frankly, not insulting anybody but out there, but if you're an asset manager of a bank or a finance company or a credit union, your job is to move files off your desk and get rid of them and get rid of those assets, whether they're a property or an REO or a defaulted loan. That's the job of the bank, is to get rid of them. And if they can build a relationship with somebody that they know they can trust and get the job done for them, you're going to see a lot of loans from those guys. And remember, those guys, it's not their money, it's their job, and their job is to get rid of that paper, those loans and the bad assets off their desk. Whereas if you go into a private lender who actually made the loan with their own money, they're not quite as desperate, if you will, as what we may be seeing at Wells Fargo or Bank of America or Chase.
Okay, great.
Does that answer your question for you, do you think?
Right. You're thinking the private lenders might not offer the same discount because
Right.
they feel it more than something else, and they don't have the insurance that the large lenders do.
They don't have the government to go back on.
Now, let's talk about who it is that you're talking to. Asset manager, is that the only title that somebody would have? Special asset manager? What are some of the other titles of the people?
Special asset group, asset manager, REO manager, and those are the three things that I could think of right now.
Now, besides that, there's foreclosure companies. There's companies that just handle foreclosures for other lenders. Would that be a good person to talk to as well?
Probably not at this point.
Probably not. Why not?
Because typically what you're going to find is the trustees are going to be loyal to the investors. So what you're going to want to get from the trustees that are actually doing the foreclosure is you're going to want them to introduce you to their lender and make the offer that way. That's where they're going to be helpful for. But the trustee doing the foreclosure doesn't have any say, if you will, of whether or not that particular lender they represent will discount the loan or not.
Okay. Now,
Excuse me, I'm sorry.
Go
But
ahead.
they are good to go to get the name of the bank and the actual lender. That's where they're going to be helpful for you.
okay. Now, with that said, if you're watching this and you're Bob and you know Chuck and Chuck knows Pam and Pam knows a person at the bank, that is like a daisy chain. I'm not really looking for that, you know what I mean? Just to be totally honest, we need the names of the actual people that can make the decisions. We can't pay 4 different people on one of these deals. If you bring us a name of a person who actually does this, we're happy to pay on those referrals, but we're not paying everybody. So if you're watching this and you don't know these people, we're not trying to teach you how to do it. Frankly, it's a relationship business. We're looking to leverage someone who's existing relationship, have some quick introductions, and try to get a quick $10 million on the street by the end of the year. That's my initial goal, to see how easy and quickly we can get the money out there. So let's kind of talk about the process, right? So let's say somebody calls me up, say, I know Bob, he works at B of A, he's a special asset manager, he's got a huge book of business, let's talk to him. All right, so I call up the guy at B of A. What's the process? He sends me what am I going to have to do? Do I need to register with them first? Is there a verification process?
Typically, they're going to make you sign an NDA.
Mm-hmm.
Okay, and if they want proof of funds, we can provide that for you. But they're going to want to sign an NDA. Some of these guys will ask you for proof of funds. They want to make sure you're not a broker and that you're a direct lender. And then what they'll do is you just tell them who you are, what you do, and what you're looking for, and you'll send over a deal after the NDA. They'll either send over an individual deal or they'll send over a pipeline of deals that you could bid on.
Okay, and when they send over a deal, it's like a summary or the entire package?
They'll usually send you the entire package.
Okay.
And we go through it with you and make a decision real quick.
Okay, great. So let's say we decide we want one, then they'll give us a loan sale agreement and we'll just purchase it. And then we're going to be reaching out to the borrower, trying to get them back on the line and try to rework the loan.
Right, rework the loan. It's a real win-win for the borrower, for you guys. And like I say, unfortunately, the only loser in the situation is really the bank. But they can afford to take the hit because
that's how they're
part of their
structured.
process.
Because they're too big to fail.
They're too big.
The
to
government
fail.
will bail them out if they have to do too many.
My uncle bails them out. My uncle will just pick up the phone to my Uncle Sam and he bails them out.
Your
right.
Uncle Sam. All right, so that's an overview on the process. I think that's pretty. Oh, we got another question.
Yeah, so we do have a question here. And this is from, let's see here, Sherwin Crowell. I apologize if I butchered your name. So you were looking for contact information from the servicing company's assets manager. Is that correct?
Yes, we're looking for people that can introduce us to the person who manages who's in charge of getting rid of these loans. Every lender is going to have somebody in charge of getting rid of the bad loans. unless it's a real small lender, and then it's just the principal of the company, they'll know that they need to get rid of it. I mean, unless you're watching this and you are that person, even better. Contact me. If you're the person with these notes, great. We'd love to buy them off you.
Hopefully that answered it for you, Sherwin.
Okay, great. Is that it? That's pretty much it for what we have. Is there anything else, Darren? That's it, right? Just questions, right? So we got to open up for any more questions if we have them. While we're waiting, try to think of another example. What's another deal that you did?
I did a deal in Arizona. It was a apartment complex. The guy actually lived in California, and I can't remember who I bought it from, but it was a smaller bank. I think it may have been a credit union.
Mm-hmm.
And the bank had this guy in technical default. His note came due, and the bank wouldn't re-extend him. And it was a great little apartment complex in Chandler, Arizona. And I went back to the guy, and I bought it enough of a discount. I rewrote it for the guy, and he just cashed us out because I gave him a several $100,000 discount.
Cash us out, meaning he went and found another lender
to pay us off.
Pay the loan off, and probably at a lower interest rate or something like that, right?
Well, it didn't matter if the rate was even higher because he took such a huge discount off the note.
But if we gave him a discount or reworked a new loan, why would he have somebody pay us off? They wanted to get rid of our loan versus...
I gave him an option, pay me off or...
Yeah, okay, so it was an option, it wasn't...
Yeah.
Okay. So sometimes we'll just go and say, hey, you owe $2 million, but if you can give us 1.5 now,
by
we'll
30 days.
Close this out.
Right, and that was the situation with that guy.
Okay.
And then I bought a tremendous amount of single-family homes back in the day when you could buy them, and they were owner-occupied as defaulted loans, and we would just go back and reperform those notes, or foreclose, or continue the foreclosure.
Reminder, $100,000 is the minimum. Right now we're starting with a cap of a $3 million loan. That's the maximum loan size for now, and we'll just kind of see how it goes. Darren?
All right, so we do have a really good question from JD. How much are you paying?
It's going to be different depending on who it is, so we'll deal with that individually per person. It depends on if you're a member office or an agent. So when I contact you, we'll go through that.
Cool.
All right. Well, I think that's probably it. We can wrap it up for the day. Anything else? Okay.
I have nothing else. Please call with questions and concerns, and let me train you however I can to go out there and talk to your contacts to start to look at some of this defaulted paper we can make money on together.
Great. FINANCEAGENTS.net. We've already had a bunch of people go there, so I'm going to be calling you and starting at about half an hour here. And then hopefully we can put together 10 million. Let's see how quickly we can get the first 10 million in defaulted notes on the street. All right. Thanks for coming. Subscribe to the show. We're out.